As you would agree, retaining your loyal customers is a lot less expensive than acquiring new ones. But this is easier said than done. Banks have long used loyalty programs centered around a single product, usually credit or debit cards, to reward customers and drive retention. But today these measures lack the oomph and are non-compelling to the bank's customers. For banks, the need of the hour is a relationship-based loyalty solution that takes into account the customer's relationship across the multiple touch-points with the bank, reflecting the total relationship value and not just single products and services. We have been working with banks over the last several years. We see essentially three practices emerging that have helped banks enhance their cross-sell and retention efforts and increase return on investment and profitability. The first being product portfolio penetration and cross-selling. This is done by creating loyalty programs that reward customers for availing multiple products and services. Rewards can be earned by customers based on deposit or investment balances, the number of products held, the number of transactions done, channels used, payment by direct debit, or even one-time events like taking up a mortgage. The idea here is to reward the customer for every relationship they have with the bank across all products or business units. Driving customer behavior is the second practice. Industry pundits agree that customer behavior can be swayed by rewarding or penalizing the customer. Just because a customer happens to have more products, he is not profitable unless the products are actually being used. For instance, a customer who has an account but does not maintain any balance is not profitable. A customer who has subscribed to online bill payment but never pays bills online is not beneficial. Rewarding customers for maintaining higher balances, rewarding points only when they pay bills online, and charging lesser fees when they use preferred channels are means of influencing customer behavior. And finally, optimal segmentation. Not all customers are equal or have similar needs, so a broad and generic reward program is not optimal. The right strategy is to align benefits with customer value, depth of the relationship, and customer preferences. Just to illustrate, students are in need of education loans, consumers in higher age groups look for mortgages and auto loans, consumers with families are looking at savings and investment options. Therefore, rewarding different customer segments as per their needs is a win-win strategy for both the bank and the consumer. Similarly, the redemption scheme should also vary by segment and should fit the lifestyle of the target audience. Banks should have multiple options for redeeming points to satisfy every customer's needs or desires, like cash rebates for paying school or university fees, repayments on home loans, reduced loan interest rates, exclusive holiday packages, etc. Following the three practices is a good start, but a loyalty program cannot be sustained unless it is constantly reviewed, analyzed and evaluated. It is important to understand how the program has affected performance, whether customer behavior has changed as expected, product sales have increased, and customer experience and satisfaction have increased. Based on the observations, changes need to be made to the program. Monitoring, reviewing, and making relevant changes to the program in real time should be built in. It is easier said than done. Implementing an enterprise-wide relationship-based loyalty program requires a centralized platform that has data from all products to give a holistic view of the customer. But unfortunately, most banks today work in product silos that are decentralized. Existing loyalty solutions are all product-centric and not customer-centric. There is a separate loyalty program for each product. Besides, these existing systems are not flexible enough to incorporate personalized loyalty programs or programs based on multiple parameters like value, volume, profitability, balances, etc. Also, banks do not have modeling and analytical tools that constantly monitor the progress, trends, and effectiveness of these programs. There is no way to simulate hypothetical scenarios to see the impact. Whatever be the reason for a bank to choose a loyalty program, the overall strategy should also include centralized relationship-based pricing, or RBP. RBP advocates that each customer is different and needs to be treated differently. It enables banks to price products and services dynamically for each customer depending on the value the customer brings to the bank. Personalized pricing, relationship discounts, fee waivers, product bundles, volume and value-based pricing are all features of RBP. Most loyalty programs are just stepping stones for banks to ultimately move towards a complete RBP model. The icing on the cake would be an analytical modeling tool that can monitor progress using the data from the RBP and loyalty tools to simulate various pricing and loyalty programs and help the bank choose the best value plan. To help you implement a comprehensive relationship-based loyalty management program and increase profits and customer retention, please contact us.